This video is brought to you by Chetan Patel, CEO and founder of MWH Holdings Group. Have you ever wondered who safeguards the capital markets from potential disasters? It's a question that may not often cross your mind, but the answer is vital to the functioning of our global economy. In the vast and complex world of capital markets, there's a select group of individuals who act as the invisible guardians, the unsung heroes, if you will. They're the ones who keep the wheels turning, ensuring that the market maintains its delicate balance. Who are they, you ask? They are the risk managers. Risk managers are a bit like the superheroes of the financial world. They don't wear capes, but they do wield a powerful weapon: knowledge. With their keen understanding of the markets, backed by years of experience and sophisticated tools, they are able to identify, assess, and mitigate risks that could potentially wreak havoc on the market. Their role is essential, even more so in a world where market dynamics are constantly shifting. They are the ones who ensure that the market doesn't crumble under the weight of uncertainty, that it continues to function smoothly even in the face of adversity. Risk managers deal with a variety of risks, each with its own set of challenges. There's market risk, which revolves around fluctuations in interest rates, exchange rates, and stock prices. Then there's credit risk, which concerns the likelihood of a borrower defaulting on their obligations. Operational risk involves the potential loss from inadequate or failed internal processes, people, and systems. And lastly, we have liquidity risk, which is about the ability to sell an asset without causing a significant movement in the price. Each of these risks requires a unique approach, and it's the risk manager's job to devise and implement strategies to keep them in check. They're the ones who ensure that the market doesn't spiral out of control, that it remains stable and resilient in the face of potential threats. So, those invisible guardians who keep the market in balance, they are the risk managers. They may not be in the spotlight, but their role is crucial in maintaining the health and stability of our capital markets. They're the unsung heroes, the protectors of our financial world. Remember the 2008 financial crisis? Let's dissect how risk management played a crucial role during this tumultuous time. In a nutshell, the 2008 financial crisis was a watershed moment in the world of finance. It was the year when the cracks in the global financial system were exposed for everyone to see. The housing bubble had burst, leading to a domino effect of collapsing banks, skyrocketing unemployment, and economies in freefall. But amidst the chaos, there were unsung heroes working diligently behind the scenes: the risk managers. These individuals had the daunting task of identifying and mitigating risks in an environment that was nothing short of a financial storm. Despite their best efforts, many risk managers were blindsided by the sheer scale of the crisis. The traditional risk models, which were based on historical data, failed to foresee the magnitude of the impending disaster. This was a significant failure, but it was also a wake-up call. Risk managers realized the importance of stress testing, analyzing how financial institutions would fare under extreme conditions. They understood that relying solely on historical data was not enough, and that they needed to consider worst-case scenarios. Moreover, the crisis highlighted the need for better communication between risk managers and the higher echelons of financial institutions. The risk managers had identified the risks, but their warnings were often overlooked in the pursuit of short-term profits. This crisis was a testament to the importance of risk management. The risk managers who succeeded were those who thought outside the box, who didn't just rely on models and data, but also used their intuition and experience. The 2008 financial crisis was a stark reminder of the potential devastation that can occur when risk management fails, but it also served as a catalyst for change. It led to stricter regulations, improved risk models, and a greater emphasis on stress testing. It was a tough lesson learned, but it underscores the importance of risk management in preventing similar calamities in the future. Now, you might be asking, how exactly do these risk managers operate? Well, let's delve into the daily operations of a risk management team. The first process is risk identification. It's like being a detective in the financial world. The team scours through every aspect of the business, from market trends to internal operations, to identify potential risks. These can range from credit risk, market risk, to operational risk and beyond. Once these risks are identified, it's time for risk assessment here. The team evaluates the potential impact of the identified risks. They'll ask questions like, what's the likelihood of this risk occurring, or how severe could the impact be? This stage is crucial in prioritizing risks and determining where to focus their efforts. Next comes risk control. This is where the team formulates strategies to either mitigate or completely eradicate the identified risks. They could decide to avoid the risk by not engaging in a certain activity, or they could choose to reduce the risk by implementing certain controls. Sometimes they might even transfer the risk to another party. The goal here is not to eliminate all risks, but to manage them in a way that the company can comfortably handle. The final step is risk review. This is an ongoing process where the team continuously monitors and reviews the existing risks and the effectiveness of their strategies. The financial landscape is ever-changing, and so are the risks. This means risk management is not a one-and-done task, but a never-ending cycle of vigilance. These teams also employ a variety of tools and strategies to manage risk effectively. From sophisticated risk modeling software to stress testing scenarios, they leave no stone unturned in their quest to protect the company's capital. So you see, risk management is a meticulous process, a delicate dance between identifying, assessing, controlling, and reviewing risks. Each move is calculated, each step is deliberate. Indeed, the inner workings of a risk management team are as intricate as they are vital. So, what have we learned today about the unsung heroes of the capital markets? Let's revisit the key insights. We've delved into the world of capital markets, where risk management teams act as the invisible guardians, working tirelessly behind the scenes. They use their expertise and sophisticated tools to analyze, identify, and mitigate potential risks, ensuring the market's stability and our financial safety. We've also journeyed back to the 2008 financial crisis, a sobering reminder of what can go wrong when risk is not properly managed. It highlighted the critical role of risk managers in preventing such catastrophes. Furthermore, we've explored the day-to-day workings of a risk management team. It's a complex and vital process, involving constant monitoring, analysis, and action. With all this in mind, we can truly appreciate the pivotal role these unsung heroes play in our financial well-being. Next time you invest or even hear about the capital markets, remember the invisible guardians, the risk management teams who work tirelessly behind the scenes to ensure the market's stability and your financial safety.